Welcome back to Rockstock Channel. It is Friday, May 3rd at 9 in the morning, and we're very happy to have back Jordan Roberts from Fastmarkets, fresh off of returning from a very well-attended Seoul conference that Fastmarkets put on last week. Want to flag for everybody, Rodney and I will be presenting, moderating at the upcoming Fastmarkets Lithium Supply and Battery Raw Materials Conference from June 23rd to June 27th in Las Vegas. Last year had record attendance. And for the first time, Fastmarkets has actually given us a discount code to give to all of our viewers here. So if you're interested, we would strongly recommend all our viewers, if you come to Las Vegas, you can get a 15% discount by mentioning the code ROCKSTOCK when you talk to Fastmarkets. So would encourage you to do that. Jordan's going to introduce himself and a couple of new initiatives that Fastmarkets has. But before we do that, I just want to remind all of you, if you like this video, please like and subscribe to Rockstock Channel. We're going to be publishing our upcoming Lithium Bull in a week or two. And if you'd like to get that directly emailed to your email box, register your email at rkequity.com. And also, we just interviewed James Brown of Sayona, the CEO, and it was a 90-minute interview. And we're going to be publishing that, in long form only to our Patreon subscribers. So if you're interested in that, we would highly recommend you go to patreon.com/rockstock channel and register, for the $10 a tier, $10 a month tier, at least, even if you do it just for 1 month, you can get that video. So with that, Jordan, let's just kick off real quickly. Just remind our viewers who you are, and but you gave some presentations in Seoul, which we want to, discuss there. Most interestingly always is, the pricing outlook that Fastmarkets has, and some other topics, which we'll get into.
Yeah, Howard, Rodney, thanks for having me back on. Always a pleasure. So as Howard said, I work for Fastmarkets, senior battery raw materials analyst, primarily looking at lithium. And I tend to look after our kind of short-term and long-term forecasts, as well as contributing to our sort of regular conferences, things such as cost modeling, etc., and really driving that interaction with our clients.
That's great. We listened, one of our frequent guests is Matt Fernley, and he has a podcast with Cormac O'Lair, who is one of the presenters in Seoul, and in their recent podcast, they talked about all the smiles on the faces of lithium executives, and they've gone full bull, lithium equities. So why don't you just do you agree with that sentiment, with respect to lithium, and if so, why, and if not, why not?
No, I definitely agree. I definitely think there was an improved sentiment around the place. I think if you had the conference a couple months before, it would have been a lot more doom and gloom. But I think the sort of positive demand data that we saw out of China in March, in terms of sort of battery production and installations, some of the production cuts that have happened have all sort of spurred this increasing positive sentiment. I think there's still some hesitation with the near-term demand outlook. A lot of market participants remain cautious, but I think overall, there's certainly improved sentiment over the next couple of years. And I think that's sort of going to be reflected in the price. I think it's reflected in the spodumene price currently. That hasn't necessarily translated towards salt prices in the CIF market. The positive demand data that we've seen in March, if that's backed up in April as well, we're going to see that translate through to, 6 months down the line when it gets through the value chain, to positive sort of upstream demand prices in the third or fourth quarter. Having said that, we still expect a strong price in the second quarter. I think, it's the restocking that we've seen over the last couple of months hasn't really spurred the price on as much as we expected. However, considering we're only sort of a month into Q2, we're quite hesitant in making any sort of drastic amendments to our price forecast for Q2. Um, the market is lacking a bit of direction, but there are several signals that support price upside for lithium salts. Although the increase may not be as strong as initially expected. I think if I could there's probably 4 points I would cover. The first is the strength in the spodumene price, which I think supports potential for higher lithium salts prices. And I think some sellers are holding that stock in tight hands on this possibility. So, if you're purchasing spodumene at current prices of between $1,200 to $1,300 a ton on a CIF basis, you're processing that in China, you've got costs of roughly 90 to 100,000 yuan per ton. So if you're selling it in the Chinese spot market, you might have a margin of $10,000, $20,000 a ton, 9 to 18% sort of margin. But if you're converting that into dollars per kilogram and you're trying to sell into the CIF market, the current spot price in the CIF market is about $14.3 per kilogram. So you are break even basically, because your costs are $12.9 to $14.3 per kilogram. So break even, or at best a 9% margin. Let's argument say you wanted to have a 20% margin. You need the price of the lithium salts in the CIF market to be between 16.15 and roughly $17.9 per kilogram. So that's a considerable amount lower than the prices that we're seeing currently. So I think the spodumene price, number one, supports a potential uptick in the lithium salts price. And if we look back kind of historically, the margin since about 2018 has been about 64%. So we're way below sort of the historic margins realized. And I think the kind of second supporting factor is Chinese publication of its new sort of auto policy, which is aimed at boosting consumption. We saw a little rally in the Chinese lithium futures after that announcement. We've seen a couple cities onboarding, and we expect more. And the scheme really is encouraging consumers to trade in old cars for new ones, offering subsidies of up to $1,400 per vehicle. And that's going to run until the end of the year. So the policy is expected to generate sort of incremental sales of an extra 400 to 800,000 new energy vehicles. But I think it's important. It doesn't just cover EVs. It's any sort of durable household goods. And that's going to boost consumer spending across multiple sectors and sort of improve that household confidence, which we know is really important for sentiment in the Chinese market, especially when it's tied to the property sector. I guess the risk with that second point is that households sort of front load their purchases. So are you just bringing demand forward? So that's something else to watch. Third point is the report from the Yiqing government relating to the sort of processing of the tailings. We expect that to add additional costs, which should raise the cost curve. Another positive for price. And I think the fourth is, like I mentioned, that strong battery production and installation volumes in March, which has improved sort of market sentiment. We'd like to see similar positive demand in April. But I think it does a lot to boost that positive sentiment further, and sort of that confidence that demand is heading in the right direction into the second half of this year.
Great. Could you just remind us what your current forecasts, the actual price forecast? You've said you've not updated them yet, but what are they at present?
The present forecast is for Q2 to average $17.5 per kilogram. And the spodumene to average 1,350. And then Q3, Q4 is range bound between $16 and $16.5 per kilogram, and around $1,200 per ton on the spodumene.
So you're forecasting it to go down by Q3, Q4, despite we haven't changed this outlook yet.
That is because although we're moving from a period of sort of weak demand and weak supply to strong demand, but also strong supply. So we still think that much of the sort of demand increases that we'll see from this positive data, potentially the ramp up and delivery of these lithium units that we're seeing from projects and expansions should still lead to good supply availability and keeping prices sort of range bound around current levels.
Jordan, just to touch on the one on point three, with the additional washing of the tailings and so on, to quantify that into hard numbers, where do you see now the marginal cost of production for the lepidolite on that base? Let's just ignore the hazardous risk as well with heavy metals and just deal with the washing of it. How much does that push costs up?
Yeah, good question. So we spoke about this last week in Seoul, and our Chinese analysts said that if the carbonate prices currently were to fall under 100,000 yuan per ton, you'd start seeing lepidolite production start to shut down. So I think that's your current sort of base level. Anything below 100,000 yuan per ton, putting pressure on. I think the washing, depending if it's classed as sort of industrial or hazardous, is going to be anywhere from a few hundred additional yuan per ton to 5,000 additional yuan per ton. So I think you're increasing the cost base by maybe 10%.
Okay, great. And I guess just a lead on from that. So there are analysts who have in their projections quite a substantial increase out of production for Chinese lepidolite. I guess that's premised on a certain price for lithium, but how likely are we to see issues around just simply the removal of waste, around greater inspections, around, further issues, given where we're already at these production volumes? Does it pose a risk as further production comes out? Because if you look at the grades and you look at the amount of dirt people are having to move to produce these volumes, is there a possibility that we're going to see actual production volumes come in below forecasts?
Absolutely. So we've already heard that some non-integrated lepidolite producers that are producing carbonate, don't own their own mines, are already looking at switching those lines to process spodumene because of the less waste, the less hazardous material. We're also hearing that Jiangxi Nanxi Lithium potentially is looking to divest of all of its lepidolite assets in the Jiangxi region and focus just on spodumene assets in the Xinjiang province. And we know that two projects, one is struggling to gain the mining license. And that is a project that has over 70,000 tons of capacity, which many people will be including in their production forecast moving forwards. So there's a risk that doesn't come online. And although a lot of people, including ourselves, see quite ample supply over the next 2 years, removing a project of that scale has a significant impact on the market balance. And it does have the potential to swing from surpluses back to a balanced market or even a deficit. So it's going to be really important to watch these sort of large scale carbonate producers from lepidolite sources in China, because they do have a material impact on the market. And there is potential, not just because of these, this is prior to the latest sort of announcement about hazardous waste, that they're already looking at switching to spodumene lines or looking to sort of divest of assets. So
yeah, that's interesting. And then just you've touched on it, and my models show the same. Are you in agreement that it's not a material amount of volume that can swing this market either way? It's still quite sensitive, even though we're up over the 1 million ton, and this is going to be about 1.2. 50,000 tons here or there has a big impact.
absolutely agree. Yeah. I think if you look at sort of Greenbush's production in Q2, that would still lower than most people had factored into their model, maybe an extra 15 kilotons off 2024 volumes. That will have an impact as well. So I think it's still tentatively balanced, I would say. I think it's another reason for the sort of the positive sentiment that's sort of turning around, is we are starting to see the impact of the price on supply now.
And I was also quite surprised at that number. And I agree, guys trim back, although they sort of looking to do something more aggressive going forward. But that raises the next question is, Albemarle said in the earnings call that if prices remain subdued, they are going to cut back capex, which makes complete sense. And we get that feedback from all of the ex-China producers that we speak to. And having had a look at some of the quarterlies I'm seeing in the sort of developing junior side of the spectrum, but even some of the companies that are going into production, a lot of them across the board, they maybe have 2 quarters of cash to survive. And it's going to be quite difficult for a lot of these companies to all try and raise at the same time. So do you see, which was what my question about, can, Chinese lepidolite in Africa DSO, can they step in and make the difference? Because we could be seeing quite a slowdown in the pipeline if we continue at these price levels for the next few months or a year.
Yeah, I certainly think that the risk is certainly to ex-China supply. I think African volumes and Chinese domestic volumes will be what they need to be to keep the downstream running in China. From our point of view, the current price environment will be felt considerably sort of 2027, 2028 onwards, where we expected projects to be finishing DFS, accessing capital, moving towards final investment decision, to be ramping up in 2027, 2028. And the longer this sort of price environment continues, the less likely those greenfield projects are gonna come online. I think brownfield's a little bit different. Yeah, we still see Pilbara, Sigma, expanding volumes. They're high quality assets. Doesn't cost as much. It's not as capital intensive to bring on brownfield supply. But certainly to greenfield supply ex-China, there's a real risk that we're not going to have the volumes we need towards the end of the decade.
I would agree with that. We've seen that in the past cycle, and now we're building, the foundations being set for the next sort of squeeze. But on that front, do you hear much from your side about potential consolidation, etc.? Because there are, as I say, lots of companies that are going to need money that don't have. And I can't see that they, unless they are lining up to be really decent assets, they are going to struggle to raise money in this environment.
I haven't heard so much on the consolidation, but I touched upon it in the presentation that I gave in Seoul, is that I'm really sort of thinking about central processing hubs, repurposing of latent infrastructure as a way to drive down costs, speed up permitting timelines. I think it's going to be really important to speed up permitting timelines for eventually when the price does improve, when we need to get these assets on quickly. So what's happening at Winston, what MinRes are doing with repurposing Lake Johnson, if that does go through, really important and important for the junior projects around those areas, right? To potentially, I can't raise the capital myself to build a concentrator or build a downstream facility, but I'll have a toll agreement or something with a central processing hub to process my ore. But it's not ideal. I don't think not everybody wants to do that. It's not a model that a lot of junior miners would be happy with. They want to get the maximum value for their product, and they want to be able to control what they're producing on the concentrate side. But, for some people, it will be an attractive option for sure. And I think it's something to watch over the next few years. I expect more of those sort of deals.
A couple of things that have come about in the last weeks is the futures volume on the CME. The quarterly numbers, I guess, at the end of the March were, very significant. So could you just talk about that and what are those volumes kind of telling us?
Yeah, certainly the CME lithium hydroxide contracts really starting to pick up pace now. Open interest is roughly sitting at around 23,000 tons now. Volumes, we saw a pickup in volumes after the Seoul conference, actually. A lot of people in the same area, potentially then moving on to close deals. But I think I'm going to use the iron ore analogy here again, because I think it's relevant. So both the CME and the SGX have been offering iron ore derivatives since 2010. In 2018, derivatives on the SGX were roughly 90% of the physical. If we fast forward to 2022, derivatives cleared on the SGX were about 3.4 billion metric tons, which is twice the size of the physical. This year, it's 3.5 times the physical. If you compare, say, we're about 3 years into the CME lithium hydroxide contract now. If you compare where iron ore was at that similar stage in its development, it was roughly 10% of the physical market. If we look at the volumes done in Q1 on lithium and annualize that, we're roughly 10% of the physical as well. So we're at a similar stage to iron ore. So if it follows the iron ore trajectory, and I think it'll actually accelerate more than the iron ore trajectory, based on the makeup of players that we're seeing in the open interest at the moment, which I'll touch on in a minute. But certainly, in 10 years' time, we could be trading at 2-3 times the physical, which in a market of potentially 3 million tons, that's 9 million tons potentially trading. So I think it's really interesting to look at the sort of makeup of the participants in the contracts as well. So for iron ore, initially, it was mostly banks and the physical players. Managed money, financials, they didn't really come in until about 5 or 6 years into the contract. But financial managed money is now the largest single participant in iron ore derivatives. If we compare that to lithium, of course, there's been the banks clearing OTC for OEMs that have initially come in on an early stage, but the physical is really lacking compared to what we saw on iron ore. Physical is only roughly 11% of open interest, but fund managers, managed money, they're 24% of open interest. So we've seen managed money come in at a lot earlier stage in lithium than we did in iron ore. Of course, no, that could be because less physical players, because it's not a physical commodity such as iron ore. Maybe spodumene would be a better example to have a direct comparison. And I think we will see a spodumene derivative launched at some point in the near future. But certainly, it's interesting to see the sort of makeup of those participants. And I did a presentation at the CME office in London a couple of weeks ago. And that was attended by producers, consumers, hedge funds, banks. So a real mix of participants looking to start taking advantage of the derivatives market.
If I could just ask one question on that, Jordan. So if you look at the CME and the fact that it's in quite a steep contango going out, it is, of course, a cash settled futures contract. And of course, hydroxide has a shelf life. But if you compare the forward futures curve on the CME for hydroxide versus the Guangzhou Carbonate futures, which is physically settled in carbonate, there is quite a big disparity in price between the two. The Guangzhou is quite flat. The hydroxide's in contango. And of course, I mean, if you look at the differential, you could convert carbonate to hydroxide for a lot less than what the differential is. So is some of the volume, possibly guys looking to arbitrage or relative pairs trade or do any of that kind of thing?
Potentially, I think there are some complexities in that, which maybe would put off some participants from doing so. I just think it's to do also with the makeup and a lot of the volume traded on the GFEX will be speculative. I think there's going to be less and less of that on the CME contract. It's more people really looking to hedge their exposure as opposed to speculative.
Well, if you look at cost of carry versus what the contango looks like in the futures at the moment, it makes complete sense to defer your sale as far as possible with your physical product. So, and perhaps something that would incentivize players to get involved.
Yep. I think I agree.
From a market perspective, it seems that just on X, and if you look at how equities trade, it seems much more correlated to what's happening in GFEX, right? That's quoted much more than the CME. You're saying there's more speculation or speculative interest in a physical market, right? Like, so that's somewhat counterintuitive, you would think, right? But it is the Chinese market, right? Like the CME hydroxide is an ex-China hydroxide price, isn't it? Or does it include China as well?
The CME hydroxide is settled against the CIF CJK hydroxide price
Okay, so it is China. It does include China.
on the Chinese. Yeah.
Okay, but overall, good momentum in the hydroxide futures volume. The CME has talked about having a carbonate. You mentioned spodumene may be coming soon. I would imagine carbonate should be coming soon, but you're not going to break that news on Rockstock Channel.
Probably not. No. I think spodumene certainly makes sense because what we're seeing in the development of spodumene pricing outside of the auctions is an increasing link as a percentage payable to the lithium hydroxide. So and obviously a move by ourselves to price daily as well.
That's interesting. That was a question I was going to ask. So there's no spodumene futures that you could trade. There's carbonate, there's hydroxide, but spodumene is more correlated to hydroxide. So are the participants in the CME hedging spodumene prices?
I'm not sure. It'll be truthfully, although it is more correlated to hydroxide, we have heard of people when the carbonate was at a premium to hydroxide, they just switched the contracts to referencing a payable of the carbonate. It would give them a better price for their spodumene. So it is fluid in that respect as well.
Okay. Anyway, so interesting development there. And the iron ore analogy is a good one, but the markets are much more fast moving than they were from 2010 to 2024. So I wouldn't be surprised if the take up in this market, accelerates, and it would be very interesting to see volumes on the exchange at a multiple of the actual total market. So Fastmarkets has also talked about a regional pricing initiative as necessary, and Rodney referred to pricing at current levels not being, incentive pricing. So if you're developing an ex-China supply chain and the prices are not high enough for you to kind of go ahead with that, and we're hearing from other players that OEMs, we've interviewed, Piedmont and James Brown and Chris Evans at Winsome and others, and their talks with Western OEMs, they seem to understand floor pricing. There has to be a certain level, and Paul Graves also indicated. So what is this regional pricing initiative that Fastmarkets is doing, and how do you think the market looks, in a year or 2 or 3 years in this respect?
So I think the regional pricing initiative is to take into account evolving supply chain dynamics within ex-China regions. So a lot of that is, it was important for us to separate the US and North America from Europe. European developments, very much policy driven in terms of sustainability, ESG. The US North American markets, very much driven by incentives, premiums, tax credits. And it's really come from the market asking us sort of, when is this going to happen? When are you going to have separate prices? So we're a little bit ahead of the curve. The liquidity is still low in these regions, but the price is there set up for when liquidity does increase. We actually have seen a slight differential already between the North American price and the European price. The range is about $0.50 per kilogram higher. This isn't a IRA premium yet. This is more to do with the quality of the hydroxide product being traded in North America. But we do expect that there will be some price differential in these regions within the next 2 to 3 years, once that supply chain is really built out, once we start having more cathode production in the US, when we start having more battery cell manufacturing in the US, when we see US and Canadian domestic projects ramping up, increasing liquidity in these markets. And I actually think if you're getting a sustained premium in the US market, it's only a good thing for project development in the region. It gives that confidence for investors into US and Canadian projects that they are going to receive a higher price for their product compared to if they were selling it into the seaborne Asian markets.
When we interviewed Paul Graves, he kind of indicated, that incentive pricing is like high teens, maybe even $20,000, let's say. So he's developing Nemaska and James Bay. But if he's negotiating with a Western OEM and he sees, Carbonate at 15,000 and he sees Fastmarkets saying it's going to be 15,000 later this year, and he's seeing Morgan Stanley and Goldman Sachs and everybody else, no one's saying it's 20,000 down the road, right? But he's saying I need 20,000 to justify spending $1.5 billion for my project in Quebec, even though he may get some government funding for that, and his cost of capital his hurdle rate is lower there than, let's say, Argentina. But it sounds like that's kind of the number. I'm just wondering, can you see, but everyone references the PRA's numbers, right? And Piedmont Sayona, they're selling North American lithium into China, and they're referencing, prices based on, Chinese prices, and there's a big freight differential there. So can we see a world where Western OEMs are paying 20 grand, right? And the rest, and China is paying 15 grand, and that certainly incentivizes North American projects. It also actually increases the cost of cathode and battery and EVs in these markets. And the objective is to kind of get those costs down. But how do you see that evolving? And do you think Fastmarkets with this regionalized pricing will actually influence those negotiations between lithium developers and OEMs?
Yeah, I think the main drive is just to increase transparency, make these markets as transparent as possible. The main issue is that everybody wants to pay the minimum that they can downstream. However, because of things like the CBAM and CRMA, there is an understanding potentially they will have to pay a little bit more for sourcing material from areas which comply to the various regulations, be it above prices that are being sold in the Chinese market. We look at our 10-year average price forecast. We have it at $23.3 a kilogram, about $1,900 per ton for spodumene. So at those prices over a 10-year average, that certainly is enough to hit those incentive targets that Paul have mentioned, that Albemarle mentioned on their call a couple of days ago. They were talking $20 per kilogram, give or take a few dollars. It obviously depends on deposit type, region, flow sheet. And obviously that cost basis increases as you move forward because you're targeting lower quality assets and because of inflation. So I think if that does happen and you need higher prices to incentivize that ex-China production, that will be captured in the PRA price.
Jordan, one of the questions I have is for it all to work is you kind of need the entire supply chain to happen within North America. The one spot I'm wondering about is cathode. Are you comfortable that there's going to be sufficient growth in that particular, part of the battery supply chain that it's all going to stack up?
Being in Seoul a couple of weeks ago and speaking to all the major sort of cathode developers, your POSCOs, your LGs, they were all still full steam ahead of developing both, not just battery cell production in the US and Canada, but also cathodes as well. They won't necessarily all be NCM, like maybe we thought a few years ago. There's a growing appreciation for LFP and how that fits into the chemistry outlook. But it's certainly their plans to still have domestic North American cathode production as well. Where I see a region struggling is Europe a little bit on that respect. And I think with less sort of stringent sourcing requirements in Europe in terms of, FTA or FEOC, that you may see some of that cathode demand from cell manufacturers in the region, sourced from Morocco or South America, or even China.
We were waiting for this. The low-hanging fruit was the high-margin, very high-value EVs that converted, away from us. Now we're moving into the real world as we get into the S-curve and having to now move into the mid-segment and the cheaper segment. So we're starting to see, some difficulties there, I guess, on profitability and scaling up. In your mind, what is a long-term lithium price that can be absorbed given the trajectory and technology improvements and production volume improvements in cells? What is kind of the price that the industry can absorb for EV manufacturers to still make a living and the upstream to have enough incentive to produce and supply them?
Yeah. I think at Fastmarkets, we're looking between $25 and $30 per kilogram. Certainly from the conversations we've had with OEMs, battery cell manufacturers, anything above $30 a kilogram, then you start making it sort of difficult on a cost basis. I mean, current sales in Q1, we had cell costs down below $80 per kilogram for NCM and below $70 per kilogram for LFP. I mean, that's fantastic. It's always been that $100 per kilowatt hour was like the golden level for parity with ICE vehicles. We've smashed that. We expect raw material prices to increase. And again, cell prices will increase again. But like you said, that will be offset by technological developments, scale as well. So yeah, I mean, an interesting thing as well is the influx of Chinese vehicles into Europe as well. And I think it's going to be a growing market. If we look at a recent article that I read, current tariffs are about 10%. To have sort of parity, to allow Western OEMs to be competitive with Chinese imported vehicles, the tariffs would have to be 50%. Yeah. So Volvo, they might get a margin selling a vehicle in China of maybe a couple $1,000 a vehicle. They can sell the same vehicle in Europe and make 3-4 times that amount of profit. Yeah, it's going to be difficult for Western OEMs to remain cost competitive.
Yeah, I agree. It certainly seems that way. So while we're on the topic of cell cost price, my favorite pet project, energy storage, I hear the pricing in China has come down substantially. I'm not sure where it is offshore. Looking at the amount of renewables that China is adding per year, last year was an absolute gangbuster year. They'd beaten 2022 by June already, and it looks to be going that way. In my opinion, I think China is looking to stack up to be able to compete on an emissions basis so that they can meet the requirements of rest of world. Your thoughts on any thoughts on your latest sort of update and forecasts for 2030 for energy for ESS volumes?
I was just looking at the Q2 demand numbers a couple of days ago, and I've noticed an increase in gigawatt hours for energy storage, especially post 2030. I still think that's the upside for battery demand. There's always going to be energy storage. China, very positive. The US, I think energy storage in Africa it's almost a no-brainer. We're seeing some positive policy in terms of using it to shore up grids which aren't as robust as they should be. We've seen it in Mozambique, South Africa, and I think the growth for energy storage is there's a lot higher limit to the potential than compared to e-mobility.
That was my view. The other nuance, when we have looked at it and spoken in the industry, is the size of the form factor and where it's getting to. And now you're talking about competing in the 4 to 8 hour storage market instead of up to the 4 hours. As you go over sort of 500 amp hours, you'll definitely be there. That's going to open up a whole lot more market. I mean, where can that go to?
Yeah, and I have to say, a real bright spot that we've seen is residential. I can't believe the amount of residential energy storage demand. Obviously smaller units, but if every house has a residential unit, it adds up in terms of demand. And there's some really sort of positive developments in places like the UK. We're getting behind energy storage, and we've got tariffs for our electricity where something called an agile tariff. So you pay less for times when the grid's under less pressure. So we have people loading up energy storage at a lower price, and then when the tariff is higher, just running off the battery. So I think definitely residential is also a bright spot to look out for.
Jordan, just a couple more questions. These spodumene auctions that Albemarle, Minres, Sigma, Pilbara, I mean, they talk about, we just want to increase transparency. Albemarle was never selling spodumene, so I found that to be pretty interesting. But it definitely, all of them seem to be somewhat frustrated by the pricing that's coming out of the price reporting agencies like Fastmarkets. So today in my email box was Fastmarkets spodumene price showed 12.15, for SE6. That compares to Albemarle's most recent auction, which was somewhat equivalent to like 1,300. So there's also this narrative that China talks down the price, and the price reporting agencies are, just a couple of 24-year-old kids who are phoning around, China and being influenced by, China wanting to talk down. So could you just address that dynamic and, what does it mean? Can we really be relying on, or should we be relying on, these daily price reports? Should we be looking at the CME hydroxide price, the GFEX, like the auctions? What do you make of all of this? Because it does seem to be a little bit of a swipe at the PRAs.
Yeah, I mean, I personally didn't take it that way, but I think I might be biased. But no, I think it's important. I don't think we as a PRA have any objection to these auctions. They actually provide transparency for us as well. And as long as we can sort of net back to an SC6 CIF China equivalent, it's a data point that we can use in our price assessments. The more data points we have, the more robust our prices are. In terms of like that differential, I think there's been a lot of variation in the auctions. Obviously, the Albemarle one recently was a positive. But if you look at and I think the Minres sale as well, it wasn't an auction, but they had a sale for $1,300 a ton towards the end of March. But if you look at the Pilbara mineral one, we obviously could include that in our price assessment because it's for delivery in December or Q4 outside of our sort of delivery window to be included in the assessment. But that was $1,200 on a CIF basis. We look at the Sigma Lithium, that was under $1,200 a ton on an SC6 basis. I would say, our price is always published as a range. And that range, the midpoint of that is 1,215. So there is some variation, and it encompasses a lot of the prices that we've seen when you net back it to SC6 CIF China from the recent auctions.
Okay, great. And you mentioned the positive developments in Argentina with Golan's lithium chloride. Do you want to talk about what you think that means?
Yeah, I think it's I think it's a really positive step forward. I think it increases some of the confidence in developing projects in Argentina, and at Fast Markets, we see Argentina as a real bright spot for growth over the next sort of 10 years. Probably Argentina and Africa are really the standout in terms of growth. I think, the export is obviously conditional on building a carbonate plant, and um, considering the capital constraints of just getting the ponds built and the chloride project up online, we'll see how the funding for a carbonate plant plays out. But I definitely think, if we start looking at companies being able to actually get their money out of the country as well, which I think is potentially in the works, I think it's positive for Argentina. Um, and I expect that a lot of the projects that we have ramping up over the next 2 years will continue to do so successfully.
But in terms of lithium chloride, is do is there a price for lithium chloride? Like what price can Galan hope to get, right, from a Chinese buyer? Is there a market for chloride? Do you track it? Do you report prices for it?
Yeah, we don't. It's, historically been a very captive market. It's been entirely produced by a few producers, and then obviously turned into butyl lithium or lithium metal. Um, but we know of capacity in China to process chloride into carbonate or hydroxide. So, in terms of how we see a price developing, I don't think there's going to be the transparency for us to price it straight away because of the lack of liquidity. But I think it'll be a percentage payable of the carbonate price. What that percentage payable will be, there's been talks of somewhere around 70%. Um, we'll see. We'll see how that develops.
70%. Okay. All right. We'll see. It is interesting development that the government's allowing the export of it. You talk about the India and developing Southeast Asian countries.
There was kind of a big topic in a lot of presentations and panels at the Seoul conference. My colleague Phoebe um, has done quite a bit of work looking at a Southeast Asian market and the Indian market. And what we're seeing is, although the growth rates in your sort of market leaders are starting to slow and penetration rates are obviously getting higher and higher, those countries which have been sort of lagging, Thailand, Vietnam, Cambodia, those sorts of countries, which the EV penetration rate is maybe a couple percent, they've had sort of anywhere between 100 and 400% year on year growth. So it's from a low base, and it doesn't, negate all of the slowing growth in the other more leading markets. But it's certainly a positive, and we are seeing policy in those countries which are supportive of the expansion, e-mobility, energy storage. And I think what we're really seeing in working is you have to have a pull. There has to be a carrot being dangled in the form of maybe some incentives, some discounts, some tax rebates. It's not enough to just have a policy that's trying to push you towards it. It doesn't work. People, they need that carrot to pull them along. And when we're not at the stage where you can remove that carrot yet, I think that's apparent by the Chinese policy as well, to continue this sort of cash for clunkers and offer some sort of incentive to go out and trade in EVs.
Okay, great. Listen, we really appreciate covering a very wide range of topics, but there's the lithium discourse is filled with lots of demand and supply drivers, physical and also developments on the financial instrument side. So the Fast Markets Lithium Supply and Battery Raw Materials Conference in Las Vegas over 3 days is a great venue to learn more about those. And I'm looking forward to seeing Rodney for the first time in about 6 or 9 months there. And again, if you want to attend this, mention Rockstock when you apply with Fastmarkets and you'll get a 15% discount. And Jordan, just lastly, like you said, the data points are still too soon for you to kind of change your forecast, but when might you change those forecasts, like in the coming days or weeks? What are you waiting to see? You might just reiterate the same forecast, but is there potential that you could be a bit more optimistic in your second half forecast if data in the coming days or weeks catalyze that?
Yeah, absolutely. I think I need to process some of the quarterlies that have just been released over the last few days, see what the impact is on supply. Really interested in looking what the April demand was. I think Chinese EV sales in April, just seen some of the results released yesterday or today. That looks positive. Wait for the battery cell demand as well, because that is going to translate into Q4. So I certainly think we look at Q2, there's potential that $17.5 per kilogram that we forecast might be down a bit, but it'll be outweighed by potential slightly increases in our price forecast for Q3 and Q4.
Okay, great. My sense is it might be more demand driven from listening to Albemarle and Pilbara and Sigma. There doesn't seem to be a slowing of supply. Like whatever's slow supply was a first quarter phenomenon. The second quarter doesn't seem so much, but that's, we'll see what Arcadium says. But anyway, that's my sense. Anyway, again, thank you very much, Jordan, and look forward to seeing you in June in Las Vegas.
Yeah, thank you. If I could just quickly before we go plug two things that are happening in May. We have a webinar on the 16th for pricing and hedging workshop. So if you're interested in price development, hedging, please join. Free to join. And on the 22nd of May, in the run up to Las Vegas, we've got just a global outlook webinar. So 5 minutes from each analyst on their respective markets and a Q&A at the end as well. So please join, again, free.
If you wanted to register for those webinars, is there like a way to get direct emails?
Yeah, I mean, if you're on LinkedIn, just go to the Fastmarkets page. Links to the registration pages are on all that, or just head to the Fastmarkets website and look under the energy and renewables section. You'll find the sign-up forms.
Okay, sounds good. I've heard that there was record attendance last year, 1,100 participants in Las Vegas. And when we spoke to some of your colleagues, you were ahead of last year in terms of registers. It doesn't mean there'll be, we'll see what happens. But considering a bit more of a bearish tenor to the market, to see the numbers tracking higher than last year, I don't know if that's a bullish or bearish indicator, but it's an indicator that Fastmarkets lithium business is thriving. Okay, at least the conference is. Anyway, Jordan, very good to see you again, and we'll see you soon.
Yeah, pleasure. Thank you.